got IDBI Bank, which I need to revisit once again because it was a vertical rise and then a straight line fall. Look at IDBI Bank. It is, if I look at where the stock was at the beginning of the year and then where the stock went up to and versus where it is right now, it's an inverted V. Let's look at the YTD graph for IDBI Bank. And there were all kind of rumors that government would, which surfaced up when the stock was going higher. Government would clean up the NPAs for IDBI Bank. There would be a P investor who would invest and pick up stake in IDBI Bank. But frankly, it's very difficult to really adopt such kind of accounting practices when IDBI was created with a different act of parliament, and after later on it was IDBI which became IDBI Bank. And we also know that their book right now is completely smashed out because of some aggressive bets and some credit culture issues which had haunted IDBI in the past. Mahesh Patil, good morning. Thank you for joining us. Mahesh, across the board, PSU banks are now trading way below their recap levels. 80,000 crore of taxpayer money has been smoked, and markets are still very nervous about what the prospects for PSU banks could be.
Yeah, so I think, PSU banks, after the recapitalization, we saw a good amount of interest coming back in the sector, but after the recent issues, about PNB and the stricter guidelines from RBI, I think there is some pressure over there. I think you will see, what we were expecting, that the impact of NPS and the provisioning on the P&L would be behind us by this quarter. I think you will see a larger provisioning impact in this quarter. It might continue for another year or so. So I think clearly, I think the sentiment has got hurt over there. Again, the credit growth, which was supposed to come back sharply as the banks got recapitalized, I think there is also going to be some amount of cautiousness over there. And to that extent, I think you would see some amount of slowdown in terms of credit growth. So I think overall, at this point in time, I would say that with some of these banks now quoting at significantly below book value, any kind of a dilution also which happens, and which they will need to do that, because the whole of recapitalization hasn't happened. There's still around 50% of more of amount of money which has to come in, and as that comes in at such a lower valuation, I think you will see pressure on the overall valuations will remain in the PSU banking space.
What do you make of this TCS block deal? The Tatas are looking, they've raised about $1 billion plus by selling family silver. What do you think it means for IT, and what do you think it means for other Tata group of companies?
Well, the IT sector doesn't really have much of an impact. If you look at, TCS, the promoters still hold a very large stake in that company, and I think there is need at the Tata Sons level, because they have to make payments for Tata Docomo. So that's a large payment, and also there is a statement which they have made that we need to consolidate holdings within all the group companies. So I think it's just to take care of that liquidity is what we think. I don't think there's any indication about the outlook on the sector. I think the sector outlook remains fairly stable now. I think outlook for this year, though not a dramatic improvement, but we are looking at around 2 percentage points higher in terms of revenue growth this year. So don't see such a big impact on the sector. I think the stock has done very well, TCS, in the last couple of months, and I think whatever discount what they have given, I think it's fair in line in terms of overall demand where it will be at this particular price.
Mahesh, hi, morning. Where is it that you're finding comfort then in the market, and would road EPC players be one such segment, considering how heavy and strong the order flows have been? We've recently seen some hefty orders being awarded to both Ashoka Buildcon as well as Dilip Buildcon, and we know how proactive NHAI has been in awarding contracts.
Yeah, the infrastructure sector looks to be fairly promising, and we have seen not only in the road sector, where clearly there has been a good amount of ordering which has happened in the last couple of months, but it's across other sectors also. Like, for example, railways, we have seen again a good amount of order inflows coming in across track laying, railway electrification. Also from the urban infrastructure projects, a lot of the metro projects which are coming up, that is providing a good visibility for order inflows for the construction and the contracting companies. So yeah, I think players in this sector which are slightly more diversified and catering to the various segments rather than just road construction, I think there the prospects look to be fairly good. And considering the huge build-up in the order book, the earnings growth and as execution happens over the next few years, I think should be fairly strong. And this time around, I think the margins also should be fairly decent because while we have seen many players, but since the ticket sizes are much larger, we haven't seen much competition from the smaller and the weaker players. So I think the margin profile and the top line growth should be fairly strong for some of these contracting and construction companies.
Mahesh, so where else are you finding valuation comfort in the market given the correction that has taken place all of February and even now?
Yeah, I think so. The correction has happened across the board. What we have seen, some larger correction in the financial space, especially the corporate banks, and even the NBFCs have seen some correction because of some concerns about increase in the interest rates. So I think some of the good quality NBFCs, I think we are seeing now good value stocks have corrected decently, and mind you, the growth has been fairly strong if you look at the last couple of quarters, and so and we don't see much of a challenge in terms of growth now. Again, with PSU Bank taking a backseat in terms of aggressive lending, I think the opportunity for the NBFCs to continue to grow and take market share will, I think, continue to be there. So I think some of the good quality NBFCs are now available at reasonable valuations, I would say. So that sector looks fairly exciting. Even the corporate banks, some of the large private corporate banks have also corrected decently. I think they should be able to manage, while you will see big impact in terms of P&L in this quarter, but I think the whole exercise will see a faster cleanup of the books, and banks which have got well capitalized and have got larger assets, okay, which they can sell to fund these losses, I think should be able to come up fairly well. And a lot of these banks, the mix of corporate book and the retail book is also now turning pretty favorable in terms of the retail book. So that's an area which looks interesting at this point in time, I would say. And then there's been some correction in the metal space also on the back of concerns about trade wars which have been unleashed by the US. Again, while there has been some pressure in metal prices, but we don't see that significant correction over there, and domestic market remains fairly strong in terms of growth, so I think that sector would also start, especially the ferrous sector looks fairly attractive at this point in time.
You know, we've had this chat with Rakesh Jhunjhunwala and again Chris Wood. Yesterday Shankar also alluded to this point that, you know, buy commodities. So for a minute, let's assume that commodities are in a strong uptrend. So then what happens to commodity consumers? What will happen to autos? What will happen to, because if commodity prices are going higher, commodity producers will get all the pricing power, but commodity consumers may really lack sure. that advantage.
So commodity prices have rallied, say, in the last 6 months, but what we are seeing is now more stability in terms of prices coming in and even slightly moderate correction. So I think in the last quarter, if you look at some of these auto companies and other players, the consumer durable, they haven't taken that kind of a price increase, but I think looking at the stronger demand coming in, we have seen price hikes by some of the auto names recently. So that is to take care of the commodity inflation, but going forward, we are not expecting commodity prices to really go up too much from here. I think they'll consolidate. Even there could be a slight correction which is there, but the stocks, even at these prices, even with a mild correction, I think should do fairly well in terms of strong cash flows coming in. They should be able to retire some of the debt, and that should be able to create value for some of these commodity companies. So not seeing runaway rally in any of the commodity prices.
Between December and now, what has changed in terms of your portfolio positioning? Because between December and now, we've seen a vertical spike and a straight line fall. So first the climax was made, and then post 25th of Jan, we've seen a straight line fall.
Yeah. So I think it's been a violent reaction which we have seen, and sudden. So it's difficult to really react to these kind of market ups and then kind of a downs.
No, but has anything come on your radar, a stock or an idea which you always wanted to buy? You said, look, I want to buy this business, but I'm refraining myself because as a fund manager, I don't like the price of the business. Are you getting a sense that you want to buy those businesses suddenly because stock prices have come down?
Yeah, so I think for the first time actually we are seeing now, at least in our in the model sheet, okay, when we look at stocks and project the target prices and we look at it pretty closely, we are seeing now decent upside, no? In some of the larger cap names post the recent correction. Even some of the mid caps also, we are seeing a decent upside from these levels. So I would say it's been across the board. It's more stock specific rather than any particular sector. But clearly, I think markets have corrected by around 6-7%. But a lot of stocks have fallen by around say 10, 15, or 20% also. So yeah, clearly, I think there is now more room for us to really choose and in a better position to be able to deploy the incremental cash flows which are coming in.
Mahesh, has this 6-7% correction though dissuaded retail viewers? Are you seeing any sort of redemption pressure or queries coming in from the retail clientele who are up until now, putting in money into the markets via the SIP route?
Yeah, so not more so by the market correction, but we have seen the post-budget, the long-term capital gains tax which was imposed. Because of that, there has been some kind of a slowdown in terms of flow, especially into the hybrid funds. But again, we will get a better picture of that only in the next month or so. But by and large, we continue to see retail investors. The real retail money is not really impacted. So those flows continue to remain fairly strong. And the SIP book, which has been there, continues to grow up. In fact, in the month of February, what we have seen, we thought probably we would see some slowdown in flows. It's only been marginally lower than what we have seen in the earlier months of November, December, when the flows peaked out. It's been down by around just about 15-20% or so. So at the moment, no, I wouldn't say that there has been any kind of concern among retail investors because of the recent market correction. There has been some apprehensions. People are asking now and slightly taking a cautious view. But I think looking at the stronger outlook going forward, I think the economic growth likely to improve, earnings growth likely to look better. So I think investors are looking at this as an opportunity to invest. They are no longer chasing now the market or trying to put into aggressive funds, but clearly longer term investors are seeing this as an opportunity to really come into the market. Even if there is further correction from these levels, say another 3-4%, I think you will see more money coming in at those lower levels. I mean, unless the outlook really turns negative, which you don't see at this point in time, the outlook still remains fairly positive for the markets and even for the corporate earnings.
And are you finding that money is now finding its way, or rather changing its course? Like you said, that there has been some cautious view now on hybrid funds. Do you sense that the shift is now becoming more towards large caps or multi-cap funds as opposed to maybe small or mid caps, because the correction has been larger there and people are now viewing this as a little risky going forward, considering the market outlook up until 2019 elections is supposed to be a little volatile?
Yeah, so when we talk to some of these advisors, okay, and the asset allocators, yeah, so this year going forward, because of the increase in volatility and some headwinds coming in from the global front, people are turning a bit cautious. Okay, we have seen also the bond yields have gone up, so there is some interest coming back into the bond funds. So by and large, yeah, the strategy for a lot of the advisors would be to really, yeah, they want to participate in the market. People are positive on the market from a longer term perspective and see better returns over there. At the same time, don't want to take too much risk at this point in time. So yeah, so the larger allocations would be towards funds, okay, where there is lower risk, lower volatility. And to that context, yeah, we are seeing more money coming into the multi-cap, large cap funds. Even the balanced hybrid funds, I think, will continue to get inflows. I mean, the huge inflows which came in just because of a surety of, say, dividend payout or a monthly dividend, I think that money will slow down. But steady money into hybrid funds will also come in because of the nature of these funds in terms of trying to lower the volatility and lower the overall risk.
Mahesh, I have a very simple follow-up question. The projected returns on equities are not going to be more than 10-12% now on a 5-year basis. There's a 10% tax which kicks in on that now. So that means 12% will come down to 10.5% or maximum 11.5%. That will come with underlying volatility. But you have a debt proposition where you could get about 7.5 to about 8% return, and if you invest smartly when bond yields go up and down, then you may also get an average return of about 8.5%.
Sure.
So does it make sense now to really stay with debt, because equity will not give you very smart returns, and clearly the best of the returns from an equity as an asset class that is behind us now?
So I tend to differ over there that the returns, the earnings growth in the next, say, I don't know, 5 years, but for the next 3 years would be around 10-12%. I think it will be significantly higher, because we are coming in from a very, very low base. I mean, last 3 years, as you know, the earnings growth has been fairly flat, and a lot of the sectors are now starting to improve, where the outlook was negative, be it the IT sector, the pharma sector, the telecom sector, where the earnings have been depressed. Even the corporate banks, for that matter, after this quarter, I think you should see some upside over there. So I think normally when you come in from a kind of a subdued years, when earnings growth has been depressed, even GDP has been depressed, as you see GDP growth start to improve, the earnings trajectory in the initial years is fairly strong, and we are seeing that. I think in FY19 we are looking at earnings growth of around 19-20%, which should be fairly in line. We haven't seen any downgrades to that earning. I mean, last quarter, for the first time, we have seen actually no downgrades to earnings after the December quarter. And if that trend continues, I think we should fairly be in a strong earnings growth cycle, at least for the next 2 to 3 years time frame, which should be at least in the high teens or so. So I think that is what we are looking at, and there could be some amount of derating which could happen because the multiples are high. But despite that, I think the markets can still clock returns somewhere which would be around, say, 12-13% or so, which is still a good return. I mean, yeah, I mean, the risk premium what one market would require over the, say, inflation or whatever, I think it's still a merit despite the 10% long-term capital gains tax as it may come in. So, yeah, the differential has gone down in terms of what bond returns would be and equity returns, but there is still enough kind of risk returns to cover the risk premium, which would ensure that money would still continue to allocate it towards equity. Obviously, the disproportionate allocation which happened in the last year, I think that will get balanced, but the normal allocation to equity still makes sense looking at the longer term returns what equities could offer from here on.
Okay, closing comments. What do you think is in store for some of these halo stocks, HUL, Dabur, Page Industries, Titan? These are companies which are trading at P multiples of 50, 60, even 70 times. Can they get into price-wise and time-wise correction both?
So there is some belief that as I mean last few years, many years we've seen the low interest rate regime in across the world and US that has gone into a lot of these high quality stocks, and we've seen the P multiples expand over there. I think to some extent, I think there is some correction which is happening, or a time correction which is happening in some of these really high PE stocks. But I would say that in a case like India, for example, some of these high PE stock also offered very decent growth, right? So it's not like their growth is totally absent, and especially a lot of these consumer names, consumer discretionary names especially, are looking fairly good going forward. We especially the consumer discretionary names, I would say that whether in the retailing side or the other names. So I think with growth, they're also looking fairly good. I mean, it could be anywhere between the mid-teens, around 14, 15 to around some of the consumer discretionary, it could be as around 18-20%. I think the time correction has happened. We've seen some time correction. There could be probably some more time correction, but I think overall returns for the markets are also not likely to be too great, right? People are not expecting that. So in that context, these stocks with earnings growth, stability, offering growth of around 15-16% would continue to still do well. I mean, I think we like some of these good, solid companies, and if there is for the time correction, I think they will start to look attractive. I don't see any major downgrade to multiples to some of these high quality stocks.
Fair point. Appreciate your time. Thank you for joining us.